The world is entering a period of geopolitical and economic transition that could redefine power dynamics for decades to come. This shift is not just a fleeting moment but a significant transformation that will impact international relations, trade, and security policies. Nations are re-evaluating their alliances and economic strategies to adapt to this new reality. The recent push for increased European defense spending, driven by diminishing U.S. military commitments and growing Russian aggression, is a clear indicator of the changing landscape. European nations are now more focused on self-reliance and regional security, which marks a departure from the post-World War II era of American dominance in global military affairs. This shift raises critical questions about economic stability and security across the Western alliance. The financial burden of increased defense spending could strain national budgets, affecting social programs and economic growth. Moreover, the reallocation of resources towards military capabilities may lead to a new arms race, further complicating international relations. As Europe reassesses its security dependence on the United States, the economic consequences for America and the global financial system are profound. The U.S. may face reduced influence in Europe, impacting its geopolitical strategy. Additionally, the shift could lead to fluctuations in global markets affecting everything from stock prices to currency values. This period of transition is both a challenge and an opportunity for nations to redefine their roles on the world stage. This shift is neither inherently positive nor negative. It represents a complex rebalancing of global power dynamics that will have far-reaching implications. The economic consequences of this shift are multifaceted and will unfold over time, affecting various sectors and regions differently. On one hand, the U.S. may benefit from reduced military obligations and lower fiscal pressures. This could free up resources for domestic investments in infrastructure, education, and healthcare, potentially leading to a more robust and resilient economy. The reduction in military spending could also allow for a reallocation of funds toward innovation and technological advancements. On the other, a more independent Europe will recalibrate trade and financial flows in ways that could marginalize America's influence over global markets and institutions. This shift could lead to new alliances and trade agreements that exclude the U.S., thereby reducing its economic leverage. The changes in trade dynamics could also impact American businesses that rely heavily on European markets. Additionally, the reallocation of European budgets toward defense spending could stoke inflationary pressures, disrupt global supply chains, and create unintended financial turbulence. Increased defense spending might lead to higher taxes or cuts in social programs, affecting the quality of life for European citizens. The ripple effects of these economic adjustments will be felt globally, influencing everything from commodity prices to international investment flows. This video examines how increased European defense spending impacts global economic stability, the U.S. economy, and the broader geopolitical landscape. It assesses potential financial market implications, the effect on military-industrial supply chains, and whether this shift toward European self-sufficiency in defense ultimately strengthens or weakens the transatlantic alliance. For the past 80 years, the U.S. has been the backbone of European security, providing a military umbrella that allowed European nations to underinvest in defense. NATO's structure reflected this imbalance. European countries relied on the U.S. nuclear deterrent, logistical capabilities, and intelligence operations to maintain security, while directing budgetary resources toward domestic welfare and industrial policy. However, this arrangement is rapidly changing. The Trump administration's skepticism toward NATO, and recent statements about reducing U.S. commitments, have forced European nations to reconsider their reliance on Washington. The European Union, particularly Germany and France, is now poised to significantly increase defense expenditures, with estimates suggesting a combined total of $3 trillion in spending over the next decade. This shift is not purely voluntary, it is an existential necessity for Europe. With Russia's continued aggression in Ukraine and China's growing economic and military ambitions, Europe has little choice but to rearm and reinforce its own strategic autonomy. This realignment has economic implications for global trade, investment, and financial markets, particularly for the United States. The U.S. economy, a double-edged sword. At first glance, Europe's increased defense spending appears to be a financial relief for the U.S., which has carried the burden of global security for decades. A reduced military footprint in Europe could theoretically lower American defense expenditures, redirecting capital toward domestic infrastructure and industrial investment. However, the reality is more complex. The United States military-industrial complex will benefit, but for how long? Europe's pivot toward military investment means higher demand for defense technology, weapons systems, and cybersecurity infrastructure. U.S. defense contractors including Lockheed Martin, Raytheon, and Northrop Grumman stand to gain from increased European orders. The European Defense Fund, established in 2017, has already directed billions toward procurement of advanced weaponry, much of which comes from U.S. firms. However, this window of opportunity may not last. European nations are actively working toward building their own defense industrial base, particularly in Germany, France, and Italy. If European firms gain competitiveness in the defense sector, American contractors could lose a significant share of what has historically been a lucrative market. U.S. Treasury markets and the yield curve. A looming challenge. One of the most overlooked consequences of European rearmament is its impact on global financial markets, particularly U.S. Treasury securities. As European countries ramp up their defense budgets, the ripple effects are felt far and wide. The U.S. Treasury market, a cornerstone of global finance, is not immune to these shifts. Traditionally, European nations, especially Germany and France, have been significant buyers of U.S. government debt, helping to finance American deficits and maintain a stable yield curve. This relationship has been mutually beneficial, providing Europe with a safe investment and the U.S. with a reliable source of funding. However, as European nations increase defense spending, they will need to reallocate capital away from U.S. bonds and toward domestic investment. This shift could lead to higher borrowing costs for the U.S. government and increased volatility in the treasury markets. The long-term implications of this reallocation are still uncertain, but they could fundamentally alter the dynamics of global finance. This reduction in demand for U.S. treasuries could drive up yields, making borrowing more expensive for the U.S. government. Given America's already high national debt, this trend could place additional strain on federal budgets and even accelerate the Federal Reserve's tightening cycle. Inflation and interest rates. The European factor. Increased European defense spending could also have indirect inflationary effects. Historically, large-scale military expenditures have driven up demand for raw materials, energy, and industrial components. If Europe rapidly scales its defense industry, competition for commodities such as steel, aluminum, and semiconductor materials will increase, further straining global supply chains. Higher input costs could push inflation higher, making it more difficult for the Federal Reserve to justify interest rate cuts. As the January 2025 CPI report showed, inflation remains above the Fed's target. If European rearmament contributes to higher prices, it could force the Fed to maintain higher rates for longer, potentially slowing U.S. economic growth. Beyond the financial implications, Europe's defense realignment could reshape global stability. While some argue that a stronger, self-reliant Europe enhances NATO's deterrence capabilities, others warn that it could provoke further tensions with Russia. Could European rearmament trigger greater conflict? A militarized Europe raises the likelihood of increased tensions with Moscow. Historically, large-scale military buildups have often led to unintended escalations. If European nations begin moving toward nuclear sharing arrangements or expanding military bases closer to Russian borders, it could provoke an aggressive response from the Kremlin. However, the geopolitical context of 2025 differs significantly from that of the early 20th century. Unlike the fragmented Europe of 1914, today's European Union is a unified economic and political entity, with institutional mechanisms designed to prevent intra-European conflict. Nevertheless, any shift in military posture will need to be carefully managed to avoid miscalculations. China's role, a wildcard in the equation. China's reaction to Europe's military expansion will be another critical variable. Beijing has already sought to expand its economic and political influence in Europe through infrastructure investment and technology partnerships. If European nations become more self-sufficient militarily, they may also seek greater independence in economic and trade policies, potentially distancing themselves from both China and the United States. However, China remains a major economic partner for Europe, and any aggressive U.S. policies aimed at isolating Beijing could place Europe in a difficult position. The U.S. should consider whether pushing Europe toward greater defense autonomy also risks diminishing American influence over European economic decisions. Conclusion: a delicate balance. The shift toward increased European defense spending represents a fundamental restructuring of global military and economic power. While this transition could reduce America's financial burden, it also introduces risks to U.S. Treasury markets, inflation, and geopolitical stability. The long-term success of this realignment will depend on whether Europe can effectively build its defense industrial base without triggering unnecessary conflicts or financial instability. For the U.S., the priority should be strategic engagement, encouraging European allies to develop their military capabilities while maintaining strong economic and diplomatic ties. If managed correctly, this transition could enhance global stability. However, if miscalculated, it could contribute to economic fragmentation and escalating geopolitical tensions. The coming decade will reveal whether Europe's newfound military ambitions lead to a more balanced global order or a new period of economic and political uncertainty.